Every new listing being signed by realtors is being pressured to go on the market at higher, not lower prices. Welcome back, everyone, to another week of Real Estate Trends with your host, Philip Rispoli from MyDigitalListing.com and the Taberski Real Estate team. This week is going to be fun. Why? Because the headlines from all the consultants this week are the same three words: rising mortgage rates. Yep, I subscribe to no less than a dozen YouTube real estate channels, and every one of them started off the broadcast with rising mortgage rates. So remember, if all the headlines are identical, it's not news, it's advertising. And there you have it. Interest rates just continue to climb. They are now the highest rates in more than 20 years. As the rates tick upwards, the number of buyers in the market start to retreat. That, my friends, is exactly what we are seeing in the field the last couple of weeks. In addition, as rates rise, this puts pressure on the existing inventory, making it sit on the market longer, and the more rates increase, the more it drives home prices down, potentially. At the same time, every new listing being signed by realtors is being pressured to go on the market at higher, not lower prices. And this just continues to stretch the already lengthening days that property are already on the market today. Honestly, we are only in the beginning stages of this cycle, and inventory is almost at the late summer peak. But that may not be the case for long if interest rates continue to climb. We have other issues to worry about, like, what about the over $1 trillion of consumer credit card debt out there that continues to grow at alarming rates? Or that we have the lowest consumer savings rate of all time at 4.3%, yet people are still spending. So where are people still getting all the money? It's no mystery that people have lots of equity in their homes. Maybe they took a home equity line. I think they are now Prime Plus, which makes it something over 8%. Maybe they refinanced out of 3 or 4% loans at 7.5 or 8.5 to pay off that debt over 30 years. But what about home values? One of the subscriptions I watched this week stated that there were over 20 million single-family homes out there owned by investors, that a significant portion are in the rental market. The author also said that vacancy rates for investor properties were skyrocketing, and the cost of capital was getting to the point that with failing rents, selling was a logical option. The author concluded that if investors sold off 2.5% of that 20 million in inventory, it would double the number of listings we had in the market today. That brings up a good point. Should a sell-off of sorts happen, it could quite possibly upset our tight inventory supply that is propping up our home prices. That could change things pretty quick if our economy, interest rate, and inflation don't start getting back in line. The results is home prices could start losing value. There are a lot of ways the market can bob and weave as we come into the fourth quarter of 2023. Here is what we do know for now. Our local real estate market for housing remains pretty stable. Our 33955 inventory has reduced slightly this week, as well as the days on market. Only 29% of the inventory has been reduced to meet market needs, compared to the 53% of the inventory in the 33950 zip code. In the 33950 zip code, inventory also came down a little this week. However, days on market increased, and that is in direct correlation to prices still being on the high side. Statistically, the numbers don't lie. Look, we have a very exciting 5.5 weeks left to the third quarter of 2023 before we head into the home stretch of the year. The twists and turns in this market are many, but one thing is a sure bet. The Taberski Real Estate team and MyDigitalListing.com is going to be there in the end, bringing news, bringing the marketing, bringing the buyers, and bringing the sales. So from our heart to yours, make sure you contact Jennifer at 941-229-0111 or go to MyDigitalListing.com or MyHeritageLanding.com. Like, share, subscribe. See you next week. We love you.